To begin today's discussion, please welcome our host, Docupace Chief Marketing Officer, Ryan George. Ryan, I'll hand it over to you.
Well, thank you, Kristen, and thank you everyone for joining us today. I have been in this business, almost 20 years now. And for most of that time, I worked at mutual funds, I've worked at ETF providers, I worked on the broker-dealer side, worked for financial advisors, and now working on the wealth tech side. And I can tell you, I have read a lot of research, and I have read a lot of different pieces from product providers, and from all different areas, in wondering exactly what is the most important and what's most valuable. And recently, I had the opportunity to be on the Flexible Advisor podcast with Gregg, and she showed me some research that they had done that was recognized recognized as a finalist for the Wealthy Awards, being named in New York next week. And it really caught my attention because I felt like it was something that everybody could have. So I wanted to introduce Laura, who's a good friend of mine from Northern Trust and Flexible Advisors, who's going to walk us through what they call the Scalable Advisor, the research that they've done. And Laura, welcome, and thank you for taking the time to walk this audience through what I think is some of the best research I've seen.
Well, thank you, Ryan. Thank you so much. And we were thrilled to have you on the podcast. And if anybody out there is interested, I'll share details on how to listen to that episode with Ryan. But I'll go ahead and share my screen now, maybe. There we go.
There you are.
Can you see it?
Yes, ma'am.
Okay, great. Let me just get this going. So yeah, this is what I have been working on for a little over 2 years now, and I'm thrilled to see when people learn about it and know that it's resonating. And so I hope all you folks on here will find some value in this. But what we're really going to talk about today is 3 things. We're going to talk about trust, why some of your clients trust you implicitly. Whatever you tell them you want to do, they are 100% in. But then you have those other clients, right, that do not necessarily trust you. They ask a lot of questions. They're very skeptical. We're going to talk about transparency. Why do some of your clients tell you about all of the assets they have, where all of those assets reside, and hopefully give you most of those assets, and others hide it, or quite frankly, this research revealed that many of advisors' clients just straight out lie. And then finally, we're going to talk about how your clients feel when you ask them for more money to manage. So the wallet share question, or how to get more from existing clients, is something that is enduring but not easily understood. We know it is very efficient, way more efficient, to grow assets with your existing clients rather than to always have to be spending more money to find new prospects and onboard them, and all of the work that entails. While we know that this is the best way to grow assets, it's not always the easiest way, is it? So out there in the industry, there is really not a shortage of advice to tell you how to grow assets with your existing clients. And before we embarked upon this research, we took a look at what was out there. A lot of it was really statistical in nature. Once your clients have a certain AUM, then they'll give you all of their assets, or once they retire, then they'll give you all their assets. We also found that a lot of what the industry has been telling us is that if you don't have all of your clients' assets, then you, the advisor, is the problem. Because if only you put on better client events, then you would have all of your client assets. If only you were the respected retirement professional in your geography, then you'd have all of the assets. If only you had different services or different products, or you lowered your fees, or on and on and on, then you would have all of your clients' assets. But we don't buy into that, and this research shows us why that isn't really true at all. We really refer to this issue, this dilemma, right, of how to get more from your existing clients, as the black box issue. what is going on inside of your clients' heads, their minds. What are those emotions? And while statistics about the market are generally pretty helpful, we found that statistics don't at all help you better segment your client base based on who is more likely to give you more of their assets to manage. And as I just said, it is most definitely not a matter of what you do or don't do, what you give or don't give. Of course, the caveat to that, right, is that you are giving good service and you do construct portfolios or place portfolios with good investments in them. But other than that, it's not about giving or reducing fees or all the other things we like to think about. And we believe that once you can figure out, once you can crack that black box, your clients' emotions, you'll be better able to tailor your strategy to meet them where they are and to speak to them in a manner that resonates with them. So let me tell you a little bit about this research, why we did it. A few years ago, a large client of ours came and asked what we had on asset aggregation. And so FlexShares Exchange Traded Funds, managed by Northern Trust, when we do our research, we think very long and hard about it. We don't build practice management programs that are not backed by behavioral research. And so it's a big undertaking. So we thought about this question, and the first thing we do is we look in the market and we try to figure out, has this already been done? And has this been done well? And the answer was no. There's a lot of stuff out there, right, on prospecting and referrals, but there really isn't a lot of research focused on how to grow assets with your current clients. So we tapped into a team of PhDs that we work with. Now we're based in Chicago, and these folks were trained at the University of Chicago. But we worked with them. We told them about what we were looking to do. They got excited. We got more excited. And so we kicked it off with an investor study. We talked to investors, high net worth investors that were working with advisors. And we had conversations with about 35 folks from across the country and across the high net worth spectrum. And the researchers came back and their findings were really interesting. And they said, Laura, you're ready to go to market. I felt that 35 just wasn't the number I wanted to go to market with. They assured me it was statistically significant, but we went ahead and we did an online quantitative survey and got feedback from about 400 other investors. And when that data came back, it proved that the PhDs were right. It was matching with the other survey, but I'm happy to share a much larger sample set with you today. We followed that up about 9 or 10 months later with a study of advisors. We wanted to understand how advisors were thinking about growing assets with their existing clients, what was working, what wasn't working, who they enjoyed working with, who they did not enjoy working with, and just to get some of their strategies. And so I'll share a little bit about that as well today. So the big finding is that there is no one single factor or formula of factors that dictate how your clients will think about giving you more of their money to manage. Men didn't think about it differently than women. We had a very diverse sample, Asians versus Black versus white. Nobody thought about it differently. Again, thinking this is a behavioral thing. This is an emotional thing. It's not something that you can paint with a broad brush. It didn't matter if if the clients earned their money themselves or if they inherited it. There was no easy button to figure out how to tap into this. But what we learned, and none of this is going to be earth-shattering for you, but it's really important to think about. We learned that when people come to advisors, they're coming with emotions already set. They're coming with their money stories, of course, how they were raised, how their parents worked with money, dealt with money, their past experiences with financial advisors, our industry, or just the financial profession overall. And when they come to you, they generally have an idea of exactly how many dollars they're going to give you to manage. Now, that decision is not necessarily strategic, it's just a gut reaction. What feels right? A lot of times that's the minimum, sometimes it's more. But anyhow, these emotions that drive their behavior, we found really sorted neatly into 5 distinct persona types. And we believe that once you understand the persona that you are serving, then you will have a better opportunity to relate to them better so that you can build trust and assets. So here are the 5 personas. The protector in the yellow is the most risk averse of all of the personas, and the simplifier on the right is the least risk averse. Where our work did intersect with what is already found out there in the industry is that the growth of wallet share follows the growth of trust. However, now this is human nature, right? You have some great clients, right? They are your top revenue producers, and you maybe take them to a ball game or you take them to golf, or you do certain things to build that relationship, build that trust. And we sometimes think that because it has worked so well with our favorite and best clients, that this is a winning strategy and that it will work with all of our clients. But what this research found is that that is not the case, because you need to build trust and relationships very differently based on persona. So we'll dig into the personas now. The first one is the protector. These folks just want to risk as little as possible. These clients are very skeptical. They're skeptical of the markets, they're skeptical of the industry, and unfortunately, they are often very skeptical of the people that they hired to manage their money. Now, they know, especially when the money becomes real, that it should be managed professionally. They do not have any financial or investment expertise, but they're scared. They want to safeguard their wallet. And if they do engage in a relationship, they want to do it at the lowest possible costs to reduce risk. When we talk to these folks, they often refer to themselves as DIY investors. But what that really meant, as you might assume, is that there was just a lot of cash on the sidelines. This is Christopher. He's our case study protector. He's 55 years old. He's an entrepreneur. He has owned his business his entire adult life, and he has poured his profits right back into the business to grow it. So not too long ago, Christopher divorced, and he received a very large settlement. He also received an inheritance. So this is the first time in Christopher's life that he's had any liquidity that was all of his own. This is his safety net. He knows he's going to sell his business. He feels confident that he can sell it at a good multiple, but just in case things don't work out the way he expects, this is a safety net, and he is not going to mess this up. So when we spoke to Christopher, he talked about exactly how skeptical he was. He told us that when he found out he was coming into this money, that he went online and he filled out the forms, and now he refers to the people that are replying back to his request for information as the used car salesman. He can't stand it. He hates the feeling of being sold. And he says every time they call, it just is a sales pitch, and I don't like it. He ultimately did hire a team to help him manage his money and gave them exactly 5% of his $5 million, which was what was needed to start that relationship. When we asked him how he chose that team, he said, well, I don't know. They seem like the lesser of all the evils, and they are affiliated with a well-known brand name. And while I know that doesn't exude safety, it's probably more safe than maybe an independent might be. So he told us, we asked about, how the relationship was going. And he said, well, they're really bothering me. They keep calling me to invite me to their skybox. He's in San Francisco for the Giants game. So he said that, and I was kind of taken aback. I'm thinking, well, wow, this team is doing what they should be. They're trying to get to know him, spend some time with him. But every time they called and invited him to the game or out to golf or to dinner, he had an adverse reaction to that. He saw it as a sales tactic. And with each one, became more jaded. We asked Christopher whether or not he told them about all of his assets, and he said, absolutely not. It's none of their business, but I know they assume there's more. That's why they keep inviting me to social events. He said, I'll decide when and if they'll get more of my money to manage, but they certainly have to prove their value first. So, I would encourage you to maybe jot down some names of clients that might be popping into your head as I go through these personas, so you can revisit those people later. But, how do you identify the protector? These are the folks that, if it's 250,000 or 500,000, whatever your minimum is to start a relationship, they will give you that, and most likely not a penny more. They will decline to share any financial information that isn't absolutely necessary to starting that relationship. And their concerns will exceed those of your normal clients, if indeed you have any normal clients. But you can absolutely win the protector's trust and a larger share of their wallet. The most important thing to do is to remember that these folks think it's the wild, wild west out there. They don't think that there are really any rules, and if there are, you won't follow them. Now, we know the exact opposite to be true, right? So it's important to tell them about your role as a fiduciary, reinforce that there are plenty of industry rules, but also talk about what you do as you construct portfolios or put them in pre-constructed portfolios that are built with risk management top of mind. They need to understand that there are processes in place that will help minimize their risk. Secondly, it's important to pursue a relationship with these folks. And that will be hard, especially in the beginning. As we talked about with Christopher, social things may not be the key to building the relationship. Remember that these people are skeptical. So how you build a relationship with the protectors is to show them that everything you do is not transactional in nature, that you will do things to help them that won't put money immediately in your pocket. So what can you do? Take a look at their qualified plans and give them some ideas for asset allocation. Take a call with their sister-in-law who's going through a very ugly divorce. Spend 45, 50 minutes with her on the phone. Point her in the right direction of resources that can help her out. And don't make the hard sell for her assets after the divorce is finalized. They need to know that you will work with them on things that don't put money in your pocket. And remember that these folks don't have investment expertise. So keep things simple. Identify opportunities to educate them so that they don't see the market and the work that you're doing as a high risk situation. And then wait for them. One of the things that one of the protectors said that he really appreciated from his client, from his advisor, was that he had come into some more money with through an inheritance. And the advisor said to him, hold on to that money. Let's, I want to make sure you're comfortable with me and what we're doing, and let's invest it little by little. Again, anything that doesn't seem like a hard sell will go a long way with your protector clients. So the competitor is our next persona, and investing to the competitor is a game. It is a game that they intend to win. You know these folks, they come to you and they are hyper performance driven, usually on shorter time periods. These folks love to play advisors against one another, and very often they will manage a sleeve of their investment portfolio on their own. They fully expect that they will outperform anything that you can do. These people are always the smartest ones in the room or in your office, and they will claim to allocate more or less to you based solely on the performance that you deliver. Now, this is Marg. She's our case study competitor. Like Christopher, she's an entrepreneur, but earlier in her career, up until recently, she was managing all of her investments on her own. She started to dabble in investings in her late teens. But you can see she's got 35% managed. Now, the reason she decided to take on an advisor was that she didn't understand the Roth IRA and how it could or should work in her personal circumstances. She told us that as soon as she figured that out, she was going to take that money right back and manage it herself. And as you can see, not only because of her crypto position, which in full disclosure, this conversation happened before the crash, but she is a risk taker at heart. She loves to jump out of planes, swim with sharks, ride dirt bikes. She likes the risk and she likes the reward that goes along with it. When we talked to Marg and her competitor peers, however, it was really a study in contradictions. Marg told us again over and over how she was going to get in, figure out this IRA thing, which wouldn't take her any time at all because she's very astute, and then she was taking that money back. Yet, Marg was really annoyed that this advisor wasn't doing anything to build a relationship with her, a relationship she said she did not want to have. When we asked Marg whether or not she was transparent about all of her assets, she said, no, absolutely not. I want this advisor to think he has all of my money, because if he didn't, he might do things differently. And I want a valid performance comparison. I know I'm going to outperform them. So how do you identify your competitor clients? Again, jot down a name if it pops in your head. You know these folks, they are anchored on benchmarks. When they come to you, they will probably give you specific performance goals that they expect you to meet or exceed. And every time you try to shift the conversation to planning and advice, they shift it right back to how much alpha are you delivering. They'll also oftentimes ask you about different investments. Now, be clear when they ask you about this, they're not really asking for your advice. Remember, they know more than you in their own minds, but they're asking for kind of that herd on the street. What are you hearing? They're trying to figure out on their own when they want to get in or out of a security. They'll ask you about these things and they'll most likely never come up again. Now, you can absolutely win the competitor's trust and a larger share of their wallet. The most important thing is to not believe their hype. They love to present themselves as cold-blooded business people. But as we saw with Mark and her competitor peers, they really do want a relationship. Now, how you build that relationship is going to be different than what I suggested for the protector. Now, these folks might enjoy a night at the ball game or a round of golf, but what's really going to build the relationship here is to stroke their ego. Tell them what they want to hear, what they already believe about themselves. And instead of asking for more money to manage, say things like, I assume that you have other advisors out there that are managing your portfolio. You told me you didn't, but if you do, that's fine. A lot of people work with multiple resources. But I really appreciate that you invited me on your team, and I really want to deliver or beat the expectations that you have for me. But in order for me to carry out my fiduciary duty, I need to have transparency. How can we collaborate to get that? And so, again, you're not asking for money, but you are asking for transparency, which you really do need to do to fulfill your fiduciary duty, and kind of a timeout on the whole asking directly for assets, right? What we found with all of the personas I'm going to talk about today is that, first, they understand that's how you make money, but they don't want you to be asking them in every meeting. The exact number of times that you can ask directly for assets without jeopardizing the relationship is exactly 1 time per year. But in all of your other engagements, you can be doing other things to help build the trust. And again, with trust comes more wallet share. So back to Marg and the competitors. The other thing that you really need to try to do is to bring attention to the long game. These folks are so often focused on how much alpha did you deliver last quarter or last year, which is great, but really the game they should want to win is the long game. So bring them back to that feeling of winning for the long term, and that will go a long way. So the collector is the third out of the 5 personas, and these folks just want to spread it all out. If you have folks that talk about eggs and baskets and nests, you're probably working with a collector. They hate having all of their eggs in one basket, and so many of the collectors that we spoke with use that term exactly. Diversification is so critically important to these people, but diversification is, in their mind, is not just about investment risk, about the portfolio. They truly believe that diversification of advisors will help them limit risk. And we know the opposite is true, especially when there's no transparency around it. Now, when we talk to collectors, they told us that they acquire different advisors very strategically, right? For different perspectives or different types of expertise. But at the end of the day, it was really more by happenstance than anything else. But know this, having multiple advisors and managing multiple advisors, being the quarterback, is a source of pride. They like the idea of them managing multiple professional money managers. This is Karen. She's our case study collector. She is 65. She thought she would be retired by now, but she hasn't quite hit her magical retirement number. As you can see, she's working with 4 advisors that she's picked up along the way. When we talked to Karen, we talked a lot about retirement, and of course, she wants to travel and she's excited to do that. But the thing that we talked about most with Karen is her desire to have more time so that she could get things organized for her children. She told us about what a debacle her parents' estate was. There was stuff that went to probate. It took, a couple years to get it all sorted out, and she most definitely does not want that experience for her adult children. So yeah, we followed up with the very logical question, and that is, have you considered consolidating, Karen? Working with 4 advisors is a lot, and things could be much easier and more streamlined with one advisor. And she said, oh no, I could never work with one advisor. That's just too risky for me. Now, Karen acknowledged that she's stubborn and she may be ignorant, but she really likes the relationship she has with her 4 advisors, some of whom she's been working with for more than 20 years. We continued to push on Karen, and we asked her about tax time, and she said, oh, it's a bear, it's awful. All the portals, all of the logins, I just, don't like it. When we continued to, again, push Karen about consolidation, she said, it just feels too risky to work with one advisor. But I guess if one of my advisors seemed more interested in me rather than my investment portfolio, maybe I could see giving more of my assets to that advisor. We pushed and found out that these 4 advisors that she says she really enjoys working with, not a single one had ever asked to meet her adult children. Not a single one had offered to do a financial plan for Karen. And she was quite sure that nobody knew the names of her children. You see, Karen had done such a great job of spreading it all out that everybody looked at her as a low-value client. She started these relationships, put money in the account, and then a friend or a neighbor or colleague brought up an experience they had with another advisor. She never shut the first one down, put more assets in the second one, rinsed and repeated. And so they saw no activity, no growth potential. And so they didn't spend time with Karen. When we asked Karen about whether she was transparent with her advisors about all of her money, she said, no, I tried that once a very long time ago, and it really backfired on me. As soon as I told the gentleman I had more money with other advisors, he became very greedy. And every single time he called me, which ramped up in frequency after I told him this, he was asking for my money. And it felt icky to me. So how do you identify the collector? Again, listen for terms like nest egg and baskets and whatever. Also, tap into their understanding of the market and working with financial professionals. These folks, because they are working with so many people, have a lot more knowledge than your other clients, most likely, of different financial brands, products, and services. Now, these folks might ask your opinion about advice that they heard somewhere. In this case, unlike the competitor, they are asking for your opinion. They want your advice, but they're asking you about advice that they received from another financial advisor. And again, you probably won't hear about this again. So you'll likely never be the collector's one and only. That's just too risky for them to consider, but you can absolutely win their trust and a much larger share of their wallet. And what you can do to get there is to appeal to their desperate need of simplification. Whatever you can do to make their journey easy will go a long way. Help them out, help them work through your quarterly statements, help them understand how to move things along, what they need to do. Show them, don't tell them. And lean into financial planning. In many cases, these folks may not have ever been offered a financial plan, or maybe it hasn't been revisited with much frequency at all. Now, they expect good performance, but that planning angle is really where you can set yourself apart. And through that discovery process, you'll be better equipped to get more transparency on where their assets are. And take the time to get to know them, because if you can win the relationship game, if they feel you truly care about them, you're more likely to get more of their assets. The verifiers, the fourth of the 5 personas, these are great clients to have, and you most likely have quite a few of them. Their guiding principles to trust but verify. These folks are great because they are transparent. They will tell you how much they have and where it is. They're seeking a long-term consolidated solution. They also have a level of investment understanding, which is helpful. They want to establish a relationship. They'll most likely give you a fair amount of their portfolio to start the relationship, and then they will wait. They will wait to make sure you can deliver the client experience that they're craving. This is Craig, and he's our case study verifier. He's a retired, I think, mechanical engineer. He's 63. He's working with one advisor, and that advisory team has 85% of his portfolio, but it wasn't always like that. About 8 years ago, Craig and his wife were looking for an advisory team. Craig's wife was hyper-focused on finding a great relationship fit. Craig, the engineer, could have cared less. He said, look, honey, with the assets that we have, the portfolio is going to be automated. We don't need a relationship. We need alpha. And let's just get on with that. Well, fortunately for Craig, they found a team that delivered on both, because a few years into the relationship, Craig's wife passed away unexpectedly. And of course, everything changed for Craig, including his relationship with his wealth management team. Craig was one of the folks that spent nearly 2 hours with us on the phone. He told us how blown away he was. He said, can you believe almost the entire team came to my wife's funeral? It was on a business day. He could not believe that they would take time out of their work day to come and console him at the funeral. And he said a few weeks later, one of the client associates came by his house with a food basket. And he said, I know what you're thinking, right? No big deal. You go to a grocery store, you buy a basket, done. He said, but when I looked at that basket, I saw some of my wife's very favorite things. And I knew right then that was no grocery store basket. That was a basket curated with me in mind, because they knew my wife. He gave many examples of all of the things that this team did for him in his darkest days. Another one of those examples was a complex tax form that needed to be filled out for the estate. He said, these folks never did my taxes. I've worked with the same CPA for 15 years. They never brought it up. Yet these people were on it. Ultimately, they worked with a CPA, took that burden off of his shoulder and got it done. So little by little, every time they did things, he felt more comfortable, more loyal, and he continued to move assets. Well, he's referring anybody that he can think of to this team. He will never leave them. And you know what? Craig really doesn't care that the portfolio is automated. He understands the value of relationship versus alpha. So how do you identify the verifier? Well, the great thing is they will tell you exactly who they are. They're very transparent, and they will lean into planning conversations and oversight. They're looking for somebody to provide that holistic experience, somebody that will lean in and look at their full financial life. And they do want a personal connection, whether they know it, as in the case with Craig, or not. So how do you win the verifier's trust in a larger share of the wallet? Again, I mentioned before, they'll give you probably more than 50% of their portfolio to start the relationship. But to get the rest of it, you need to identify the missing pieces in their life. Are their trust and estate docs in order? Are their beneficiary forms up to date? Is their mortgage structure right? Do they have a business that they want to sell? Can you help them get that ready for sale, or point them in the direction of some COIs that can help them? Whatever it is where you can anticipate what they need before they need to ask you about something, that will go a long way and speed things up. They want you to take that holistic approach. The other nice thing about these folks is that they can be motivated forward with incentives. So make sure, if they're close to a break point that will reduce your fees, let them know that. If you can offer them other things as a benefit of working with you at the current asset level that they're at, or another asset level, make sure they understand that. But don't cross the line with these people. They will move the remainder of their assets to you once you have delivered on that client experience that they want. However, these are transparent people and they appreciate candor. So tell them how much you want their business for the long term. Be brave enough to, of course, highlight what you think went well, but be brave enough to ask them, was there anything I said or didn't say, did or didn't do, that rubbed you the wrong way, that gave you concern? I want to rectify that early and soon so that we can build this long-term relationship. All right, here we are, the last of the personas, the simplifier. These folks just want the easy button. Their guiding principle is just to keep it simple. These folks view all of their money and assets as a lump sum, no matter where it may be. And they have little anxiety of moving everything as a lump sum very quickly. They have no investment expertise, and they don't want it. They want somebody that they trust, that can be a single point of help for them. They love having everything under one roof. And if it can't be under one roof, they want one point of contact to bring the resources to them. This is Maya. She is our case study simplifier. She and her husband, and I'm from Chicago. I'm going to tell you a little story. She's a Chicago police officer. She was also one of the most trusting people that we talked to, which just blew me away, given her career in the CPD. Well, she and her husband wanted to get out. They wanted to retire early and retire early in COVID to be closer to their daughter, who lived, I think, in the Atlanta area. So it took Maya exactly 2 phone calls, not even a Zoom, and 2 weeks to move their entire pensions and life savings to this advisor. Now, when we talked to Maya, we asked about how it was that she was able to do this so quickly. And she said, I just trusted her. She just was a lovely woman, and she just made me feel like she would be there for us. Maya also liked the brand name that this person was associated with. She liked having everything under one roof. She was offered free wire transfers, and that was a big deal for Maya. I'm not sure how often she uses them, but she liked that there were perks that went along with the relationship. And again, for those of you who may be listening that are independents, again, no worries. These people are really just looking for that single point of contact that can manage everything for them. She was very transparent with this advisor about all of her assets. We asked about the performance expectation that Maya had, and we used the term benchmark, and she kind of laughed. She's like, I don't pay attention to benchmarks. I'm not exactly even sure what they are, but I'll tell you what I am sure about. And that is when I see a number on a piece of paper, I know whether or not I'm comfortable with that number. So how do you identify the simplifier? They will tell you exactly who they are. They're open about their lack of financial expertise. They are also very open that they don't want to dive deep with you and learn about the markets. That's your job. They will have a lot of questions, most likely not about their investment portfolio, but about how this relationship will work, what they can get from working with you. And they want you to take care of everything and like having everything in one place, or that, again, that single point of contact. So with the simplifier, it's much less about gaining more wallet share because you likely have all of it, but it's about retaining that. I'm going to skip to that third bullet point. It's really important not to grow complacent with these folks, because as easy and as simple as it seems to get their assets, you can lose them that quickly and that easily if you don't pay attention to them. So make sure they understand the complete menu of services that are available to them. And again, help them access those services. Don't just tell them about it. So if you're able to offer a free credit card or wire transfer or whatever it may be, take them through. Make sure your client service associates help them take advantage of everything you can offer them. Make use of your regularly scheduled check-ins, which should be at least quarterly with these people, to remind them of all of the stuff that you've done for them, all of the stuff that you can do for them. Point out if they haven't taken advantage of a perk that's available to them. The most important thing for these folks is to not feel forgotten. They don't want to feel like a number. They want to think that they're top of mind. And when you touch base with them very regularly, I'm not suggesting that it's a deep dive on their investments. This is just talking to them about how they are. In the case of Maya and her husband, how do you like Georgia? How old are the grandkids now? What's going on? Did you take that trip you were hoping to take? It's about building the relationship and reminding them they're heard and listened to. Okay, so I'm going to shift a little bit into our advisor study. And what we found out as we were talking to advisors is that so many folks don't really identify who their ideal clients are and focus their practice there. Now, a niche practice is so beneficial. And, I've worked with folks that serve, surgeons or pilots or whatever it may be. But it's always important to remember that within that niche, there are other, things going on, different personas that exist. Not every surgeon thinks the same way. So who are your ideal clients outside of the revenue that they generate? And why are they ideal for you? Now, the first year I was on the road with this material, folks would say, which persona should I focus on? And I said very confidently, you should absolutely focus on the verifiers and the simplifiers. Seemed to make sense to me until we got data from our advisor survey. And guess what? You all have persona types, right? And what we found is that we like to work with personas that are similar to us because we get us. We understand the questions we would ask or the desires that we might have. And so it makes that interaction a little bit easier. We found a lot of advisors that really enjoy working with those competitor types. were a lot of advisors that liked working with the protectors because they liked to educate them. We also found, and not surprisingly, that most advisors allow some accommodation to the people that they take into their business. Now, there are some that told us that they make no accommodations. They outline, the asset levels that they will work with, the type of clients they will work with, and they don't veer from that. Those folks also told us they had nearly all of the wallet share from those clients. But most of the advisors we spoke to make some moderate accommodations, right? And that makes sense. We take on the children of great clients that we have. We take a neighbor or a colleague, something like that. And maybe these folks don't meet your asset minimum. Maybe they need some other things that you're not used to providing. And I just want to issue kind of a word of warning. When you take folks like that, you're doing it as a favor. You're doing it to be kind, to be helpful. But what often happens is that because they don't fit your ideal client type, they don't get the service you give to your ideal clients. They're B-listed. And as time goes by, they don't experience all that you have to offer. And so sometimes doing that favor can backfire on you. They feel like, wow, my parents, my friends get all of this. I get nothing. And then they start giving you bad reviews and start talking bad about the services that you provide. So if you are going to accommodate folks, make sure that you can deliver the service that they really need. And then finally, we spoke to a lot of advisors actually that fully accommodate their client's vision of what their role is and what their the client's expectations are. And this is not necessarily with just new advisors, which I assumed it would be in the beginning, where any money is good money. But a lot of advisors do this. I think that it's very challenging to do and do well. So, just think about defining your boundaries. The first thing I suggest is that you can define your role, that you have an elevator speech, very short and brief about, what you do and who you do it for and how you do it. And then secondly, if you don't already, make sure you have in writing your client service offering. Keep it high level, one page. You probably offer that conversation and a document, if you have it, to new prospects. But I urge you to revisit this every year with your existing clients, because we know that there can be creep. Over time, people ask you for more, you deliver more, but before you know it, you're servicing them far outside of what you ideally should be doing. And then finally, understand where your clients' expectations are every year. Is their expectation of you beyond what you can truly deliver efficiently? And if there's a gap there, try to figure out, can you bridge that gap? Can you bring it together to make sure you can service these clients appropriately and profitably? And how long that will take. Put milestones in your CRM and know when it's time to walk away. All right, we went over a lot today, and I often get asked if I'll share my slide deck. I do not share my slide deck, but I know Ryan is going to share this link after our webinar today. But we have a website that has a lot of information for you. We've got videos, we've got a podcast with the PhD that worked on this with me, white paper, and so on, and a quiz, Name That Persona. I hope you'll visit that and look at some of the materials. And now here is my my pitch for me. I'm losing my words. I host a podcast called The Flexible Advisor. As I mentioned before, Ryan was a guest. Later today, I'm recording episode 100. If you have an interest in a variety of themes in the advisory market, I hope that you will take a chance and listen to that webinar. And I'll turn it over now to Ryan. Also, he will send out information on how you can get CE credit for this presentation today.
Well, congratulations on episode 100. Do you have time for a handful of questions, Laura?
I sure do.
So one of the questions that you touched on a bit just a second ago, but I want to make sure if advisors listening, you have this broad spectrum of personas. Is it really possible for an advisor in a firm, in an office, to be able to address and have a customer experience around each of those advisors? Excuse me, each of those personas?
Yeah. So I would say yes or no. Again, I urge you to think of who you work the best with. I was working with a large RIA aggregator some time ago, and what we kind of developed for them is understanding not only the advisors in the firm's personas to understand who they might work best, but the client service associates. You know, at the end of the day, the people that spend a lot of time with your clients are your client service folks. And so they adapted by putting protectors on the phone with, with servicing the protector clients and so on. So you can, we do a workshop that we offer to small groups of advisors. And what we talk about there is you first prioritize or segment your book of business by revenue and AUM. We suggest then you put an overlay of personas and focus on those personas that you're more aligned with, and start there for trying to grow wallet share and then cascade that down.
So it sounds like even putting the personas like into your CRM or into other technology systems that you have can help align across the board. One other question that I had was, you talked about, I can't remember which persona it was, but it was this person wants to be the smartest person in the room. Have you heard any examples of advisors of how they concede, like willingly sort of give that mantle of authority of the smartest person in the room to to a client?
I'm not exactly sure how to answer that, but I would say what we do know works is to, again, what I said before, kind of stroke their ego. Ask them, talk to them on as a peer, right? They think they're smarter than you. They're not thinking that your advice is really all that valuable. We know that it is, but talk to them as a peer. So, how many more rate hikes do you think we have? What are you thinking about the security? And that kind of breaks down their guard, like, in terms of you thinking you're more or better than they are. That can help.
Awesome. Yeah, well, thank you for the time today. I really appreciate you putting the audience. As you mentioned, I will send out an email this afternoon with a replay of today, a form to fill out for the CE credit to everybody that's been in attendance. We have your email address on file from the registration. So thank you, Laura. Thank you, FlexShares and Northern Trust, for doing this valuable research for the marketplace. And we appreciate everyone's time. I hope to see you again soon.
Thank you so much.
Bye.